For more on the topic of the economic health piece of the public health puzzle, we're pleased to be joined by Jeffrey Korzenik, who is a chief investment strategist and SVP for Fifth Third Bank. Jeffrey, thanks for joining us. Appreciate it.
Thanks. Good morning, Dan. Good morning, Amy.
Morning. You can skip over Bill Ackman unless you want to opine on him. But going back to what Jim Cramer had to say, I mean, do you agree with his assessment that the proposal that's been put together and is expected to be passed by the House today and put on the president's desk is really focused in on the American worker and the American small business person?
Yeah, I mean, we're still plowing through the details of this very, very long document, of course.
Right.
But it is two things are striking. One, that there is a very large focus on small business and with the idea of supporting employment. So there's very specific tie-ins to aids and loans and forgiveness of taxes and things like that that are tied closely to employment. So I think that's very healthy. What's particularly striking is just the massive size of the stimulus. It's close to 10% of GDP. That compares to, the New Deal. The entire New Deal was 6 or 7% or 6% of GDP. 08, 09 combined, we're 6 or 7% of GDP. So this is a big move by the federal government.
And in a piece that you penned, you go through a number of considerations we should take under advisement as we're trying to work our way intellectually through this. And one is have a balanced view. It's important for us to recognize the risks of succumbing to the emotionalism of leading stories each day. Just develop that from a banker's perspective.
Yeah. So one of the things that was really striking to us was that, you learn in the markets there's a bullish story and a bearish story to everything. And the overwhelming onslaught of news and the overwhelming onslaught of immediate investor reaction was to completely focus on the negative and not see any bright spots or any positives. And that doesn't make for good investment decisions. We saw that play out in the markets. We like to say, and I steal this from my friend Chris Verone at Strategic Research, bear markets have a bang and a whimper phase. And the bang phase is where you have this wholesale cascade of indiscriminate selling. That's what we've been going through. I think that's inspired by this lack of balance. And what we are starting to transition to is where the whimper phase, where you have a little bit less volatility and you start to sort out what could work here. And then specifically, we think that the market participants have underplayed any kind of medical mitigation. They've underplayed the opportunity to have a more selective recovery strategy in terms of getting more certain elements or geographies of the U.S. economy back to work. So all these things need to be brought more broadly into balance.
As a chief investment strategist and senior vice president for Third Bank, do you advise us to look at our 401ks? Because I did a few weeks ago, and I don't even want to know right now.
You need a psychologist, not a banker.
Yeah. Presumably 401ks are retirement funds, and if you are retiring tomorrow, you're forced to take that into consideration. But for the rest of us who have many years to go of employment, you got into this as a long-term investor. You shouldn't make hasty decisions. That being said, we did advise our portfolio managers a few weeks ago to take that deep downturn and use that as a chance to rebalance portfolios. When you have bonds moving up sharply as they have and stocks moving down so sharply as they have, your asset allocation gets out of line. So it's important to use opportunities like this to bring them back into line. That ended up with, for those who did that, ended up with our buying stocks at prices below where they are today. So, so far it's been successful, but that kind of portfolio discipline in the long run always works.
It's been a good 3 days, apparently the best 3 days since the 30s in terms of some clawback. But give us a picture of what people should expect to sort of hunker down and take the highs with the lows over the next, several months at least when it comes to the market. And also specifically, are you concerned at all about a bit of a retracement back towards, Dow 18 or 17?
Yeah, I'm absolutely concerned about a retracement or, even conceivably new lows. I don't think we're done with this bang stage. There's still a lot of indiscriminate selling, and then the last couple of days, in some ways, were indiscriminate buying. Everything was going up. That's not healthy. That tells you you have not settled the market, and you're still in this phase of wholesale movements that ultimately can be somewhat dangerous. I do think we're getting inklings that we're starting to move to a little bit more discrimination between sectors. What are going to be the winners? What are going to be the losers? That's part of the next phase. You go up and down during that period. We are hoping for lower levels of volatility. We are also going to be opening up the possibility. I think that's what a lot of the last couple of days of rally was about. Investors finally understood it doesn't have to be shutting down the economy forever and ever. It doesn't have to be the Great Depression. There's a pathway that has trade-offs, public health trade-offs to be sure, but a pathway to making this shorter rather than longer episode. Either way, it's going to be a nasty episode. What the challenge will be for investors in the days ahead is the news flow. We are going to be seeing a rapid rise of infections as we broaden testing, a rapid rise of hospitalizations, and sadly, tragically, a rapid rise in deaths due to this. So those are the things that are not typically what market rallies are made out of. Markets do bottom at moments of greatest pessimism, and so perhaps that's still ahead of us. But those are going to be the challenges. That kind of news flow certainly doesn't make you feel good about the outlook. But markets are forward-looking. We as investors have to look beyond today's headlines as well.
One of Warren Buffett's many aphorisms is only when the tide goes out do you discover who's been swimming naked. And I wonder if perhaps we're looking for silver linings here, and perhaps the silver lining post-COVID-19 pandemic is a little bit of a clearing of the brush and the over-leveraged in the marketplace?
Yeah, I think that's fair. Interestingly, this cycle, and one of the reasons we think that a decently speedy recovery is possible, is this cycle, it's not the consumer. If you go back to 08, 09, we had an over-leveraged consumer and an excess of supply of real estate, which is where the leverage was as well. This cycle, we selectively have a lot of debt in corporations, but not at the household balance sheet level, at household income statements in particular. How much does it cost you as a percentage of your income to carry your debt is not particularly high. It really never rebounded after 08, 09. But you will see some companies that took on too much debt, sometimes as a result of a private equity transaction. Those will have some kind of impairment in their performance, and some may go out of business. That's probably a healthy warning to the economy not to get over leveraged. So there's some long-term structural benefits to this.
He is Jeffrey Korzenik. He's the Chief Investment Strategist and Senior Vice President at Fifth Third Bank. Jeffrey, thanks so much for joining us. Appreciate your insights.
Thank you.